Let me show you something that might shock you. I have a client portfolio in front of me, 10 different funds, spread across large cap, small cap, international, bonds, even REITs. Looks diversified, right? Wrong. When I dug deeper, 85% of this portfolio's risk came from one factor: US tech exposure. The same 7 companies appeared as top holdings across 8 of those 10 funds. When the market dropped 25% last year, every diversified fund fell together. International fund, down 23%. Small cap fund, down 26%. Bond fund, down 18%. This wasn't diversification. This was an illusion. Most investors believe owning multiple funds equals true diversification. They count holdings: 15 stocks, 8 ETFs, 4 sectors, and feel protected. But here's the truth. 95% of investors think they're diversified when they're actually concentrated in ways they don't realize. The hidden cost isn't poor returns. It's complete failure when you need protection most. When everything moves together, you've built a house of cards, not a fortress. Today, I'm going to give you the 5 golden rules of true diversification, the kind that actually works when markets get ugly. These aren't theories. These are battle-tested principles that separate real protection from fake protection. Golden rule number 1: count risk factors, not holdings. Most people think diversification means owning lots of different things. They'll buy 20 stocks and call it diversified. But if 18 of those stocks are all tech companies, you own one bet, not 20. Here's how this works in practice. Let's say you own the S&P 500 index, a technology ETF, a growth fund, and a NASDAQ index. You think you have 4 different investments. But look at the top 10 holdings of each fund. Apple, Microsoft, Amazon, Google, the same names appear over and over. You don't have 4 investments. You have 4 different ways to own the same 10 companies. Real diversification means owning assets driven by different economic forces. US. Stocks are driven by corporate earnings. Bonds are driven by interest rates. Commodities are driven by supply and demand. Real estate is driven by rental yields and construction costs. These forces don't always move together. Your action step: list your top 10 holdings across all your investments. If the same company appears multiple times, you're not diversified, you're concentrated. Golden rule number 2: separate correlation from causation. Here's where most investors get fooled. They look at historical correlations and think they understand how assets will behave together. But correlation is not causation, and yesterday's relationships don't predict tomorrow's crashes. Take the classic 60/40 portfolio: 60% stocks, 40% bonds. For decades, stocks and bonds moved in opposite directions. When stocks fell, bonds rose. Perfect negative correlation, right? Then came 2022. Stocks fell 18%, bonds fell 13%. Both assets crashed together because both were hurt by the same thing: rising inflation and interest rates. The lesson? Don't diversify by correlation alone. Diversify by understanding what drives each asset. What kills one investment should strengthen another. If rising interest rates hurt both your stocks and your bonds, you don't have diversification, you have double exposure to interest rate risk. Your action step: for each investment, write down the 1 or 2 economic factors that drive its returns. If multiple investments share the same driver, you're concentrated, not diversified. Golden rule number 3: cap your exposure to any single theme. This is the rule that saves portfolios during crashes. No matter how good an investment looks, no matter how diversified it seems within its category, never let any single theme represent more than 25% of your total portfolio. Here's a real example. During the dot-com boom, technology represented 35% of the S&P 500. Investors who thought they were diversified by owning the whole market actually had massive concentration in one sector. When tech crashed 80%, their diversified portfolios got decimated. The same thing happens today with different themes. Some portfolios are 40% concentrated in growth stocks. Others are 50% concentrated in US assets. Still others are unknowingly 30% exposed to rising interest rate risk across multiple fund types. Set hard limits. no more than 25% in any single country, no more than 25% in any single sector, no more than 25% sensitive to the same economic factor. These limits force you to spread risk instead of concentrating it. Your action step: add up your exposure to your largest theme or country. If it's above 25%, you need to rebalance, not just reweight. Golden rule number 4: own assets that behave differently. True diversification means owning things that don't just have different names, they respond differently to the same events. When inflation rises, some assets get hurt and others benefit. When economic growth slows, some sectors struggle while others thrive. Here's how to think about this practically. Stocks generally do well during economic growth but poorly during recession. Bonds do well when interest rates fall but poorly when rates rise. Real estate does well during inflation but poorly when construction costs spike. Commodities do well during supply shocks but poorly during demand drops. Build a portfolio where someone's bad news is someone else's good news. Own growth stocks and value stocks. Own domestic assets and international assets. Own assets that benefit from inflation and assets that benefit from deflation. Own liquid assets and illiquid assets. The goal isn't to own everything. The goal is to own assets whose success comes from different sources, so you're never completely wrong about everything at once. Your action step: list 3 economic scenarios that scare you most. For each scenario, identify which of your investments would get hurt and which might actually benefit. Golden rule number 5: test your diversification during crisis. Diversification that works in calm markets but fails during crashes is useless. Your portfolio needs to be stress tested against the scenarios that matter most: market crashes, inflation spikes, economic recession, and geopolitical shocks. Here's the hard truth: most diversification strategies are designed for normal times. They spread risk when volatility is low and correlations are stable. But during crisis, correlations spike toward 1, everything falls together. That's exactly when you need diversification most. Go back to 2008, 2020, or even just last year's inflation surge. How did your current portfolio allocation perform during those periods? If everything moved down together, your diversification failed. The only test that matters. True crisis-tested diversification includes assets that actually gain value during market stress. Cash gains purchasing power during deflation. Treasuries gain value during flight to safety moments. Some commodities gain value during supply disruptions. Volatility itself can be an asset during panic selling. Your action step: model your current portfolio's performance during the last 3 major market disruptions. If everything fell by more than 15%, you need more crisis-resistant assets. Now let me share the 3 biggest diversification mistakes I see constantly, because avoiding these mistakes is often more valuable than perfect optimization. Mistake number 1: confusing many tickers with true diversification. Just because you own 15 different investments doesn't mean you own 15 different bets. If they all depend on the same economic factors, you have one concentrated bet spread across 15 accounts. Mistake number 2: overlapping ETFs that all move together. The S&P 500, total stock market, large cap growth, and technology sector funds might have different names, but they're essentially the same investment repackaged. You're paying multiple expense ratios for the same exposure. Mistake number 3: ignoring concentration inside your funds. Your diversified fund might own 500 companies, but if the top 10 holdings represent 40% of the fund's value, you're concentrated in 10 companies, not diversified across 500. Here's your diversification checklist. Do this quarterly, not daily. Identify the top 10 holdings across all funds. If the same companies dominate multiple funds, consolidate or find different assets. Check overlapping exposure map. How much depends on U.S. growth, tech performance, or interest rates. Separate holdings from risk drivers. 100 holdings driven by one factor is concentration. Set 25% maximum exposure limits by sector, country, and theme. Add assets that behave differently during the same events. Recheck correlations during stress periods, not calm markets. Review quarterly, not daily. Let me recap the 3 key insights. Real diversification counts, risk factors, not holdings. If everything depends on the same economic driver, you're concentrated. True protection means owning assets that respond differently to the same events. Someone's bad news should be someone else's opportunity. And diversification must be tested during crisis, not just measured during calm markets. Remember to verify specific allocation strategies with official sources and your financial advisor. This is educational content only, not personalized investment advice.